The headline seems to be operating profit missed estimate. Are you losing sleep over that? How's the business?
Well, morning, David and Rich and Yvonne. Well, to answer David's question, I'm not losing sleep. In fact, I am actually quite optimistic about our prospects and the results that we've had. You've shown just now that, on the revenue side, we missed estimates by a little. But, if you look at the profits, we've actually over-delivered. So net profit is up, I think, year on year of 14%. And if we were to take out any of the currency impact, because the Sing dollar was very strong this past year, it was actually up 17%. And this is really very healthy growth. And we're actually quite encouraged by the strong performance on the mobile side. And actually, we're quite optimistic about the prospects of the company.
I was interesting in some of the things that you're looking at in terms of CapEx. You're also investing $500 million Sing dollars in data centers and satellites. Arthur, yes. When do you think this investment in 5G is really going to ramp up? And are you making money now when it comes to 5G?
Okay. A good question. I think, Yvonne, on 5G, we are taking a very measured approach to expanding because you're absolutely right. The use cases for 5G are still very nascent. We are starting to build out on the enterprise side. So an example is in Singapore, we're actually commercializing autonomous vehicles. We're partnered with Hyundai and various folks to actually build out using the 5G platform to build out autonomous vehicle manufacturing here in Singapore and telemedicine and holomedicine actually with some of the hospitals and all that. And all these are not just test cases, but actual commercialization. So we're optimistic, but I would say 5G, in the consumer side, it is still very nascent. On the enterprise, there's actually starting to see real use cases, and we're leveraging on that given our kind of share and our market position in the enterprise space as well. On the data center side,
sorry.
Yeah. Sorry, go ahead, please. Oh, no.
I was so on the data center side, about the mobile side of things and how much, because you had a revenue fall slightly, it was a miss. Now, how does that really sit with the number of subscribers you have, and how does that affect your ARPU, your average revenue per user is what I was going to ask you. And essentially, how does 5G change that in terms of extracting more out of each customer?
Okay, I think if you look at the revenues, that's mainly from our Singapore and our Australian businesses. The ARPUs in Australia has actually gone up, quite similar to the rest of the market. In Singapore, it continues to be competitive. But what we have done is to actually improve the quality and the value that we drive. And for 5G, we are the market leader here in Singapore. And we do kind of leverage on that to actually build out and differentiate ourselves in that space. You'll see actually on this slide, we not only are in Singapore and Australia, but we have a very, I would say, a wide footprint across the region. And, we own either the number one or the number two telcos in these countries. And you will see actually in all our regional associates, there's actually been an increase in ARPUs. I think post the COVID recovery, you are seeing actually a meaningful recovery in the space. It's contributed by, I think, the post-pandemic recovery for one reason. I think the second reason is we're actually seeing some market repair coming back to the industry. The industry is consolidating, whether you're looking at India, Thailand, Indonesia, and these are the three countries that have actually, brought kind of healthy recovery to the sector.
You were with us 3 weeks ago, the day before the FOMC meeting, and you said you thought that the Fed should take a pause then and that they might very well do that. When you read the minutes today, what does it tell you about what they were thinking now and where they're leaning at this point?
It feels to me that they're moving toward a pause. It doesn't surprise me that they're having a debate, though, because despite all these rate increases, the economy is holding up pretty well. And I think that's a bit of a surprise. Part of the reason it's been holding up, though, I believe, is you've still got the remnants of fiscal programs and current programs, infrastructure bill, Inflation Reduction Act, the remnants of the American Rescue Plan that still hasn't been spent on a local level. And I think that's working at, to some extent, cross purposes with the Fed funds increases. So this is why the Fed is trying to decide what to do. The data is still stronger than they would have expected. But I think part of the reason why is what's happening on the fiscal side of the house.
So data dependent, though, at this point, that's, we've got the meeting 3 weeks from now. So are they more data dependent than they were in the past? Were you guys always watching the data so closely? Is it more driven now by that, looking at by number? 3 more numbers are going to determine the next hike potentially or pause, and not so much forward guidance?
So in periods where the economy's at a point of inflection, I've always been strongly of the view that data should just be a part of the equation. You have to look at fundamental drivers, what's going on the ground, and what's likely to happen over the next year or two. I think it's dangerous to be too data dependent because data is backward looking by definition. And so if I were in the seat right now, I'd look at the data, but I'd also be aware of what's happening with fiscal policy and that it's blunting to some extent the Fed funds rate. The other thing I'd be looking at very strongly is the curve is historically inverted, okay? And that means I think further rate increases from here are a bit pushing on a string. They don't in any way negatively impact the ability of big companies to finance, because big companies finance based on the Treasury curve, and the Treasury curve is downwardly sloping. Pfizer just did a $31 billion debt deal below the Fed funds rate. Fed funds increases at this point disproportionately hurt small and mid-sized businesses and small and mid-sized banks. And that would be another factor for me to say, I think the marginal return of additional rate increases is diminishing here. And I'd rather pause. And I like the idea of a hawkish pause, meaning we're in a tightening stance, but we're going to adjust the data and turn over a few more cards before we take action. That's what I'd be doing.
I wanted to pick up what you mentioned about the impact of fiscal, right? Because obviously there are still multiple fiscal programs ongoing, inflation reduction, the infrastructure bill, et cetera, that you might typically see post-recession. How much do they, in addition to what shape the final debt deal takes place in and any kind of spending cuts that are tied to that package, how much does that really complicate the outlook for the Fed?
I think it complicates it in that the American Rescue Act money, that was passed back in 2020. I can tell you firsthand, because I talked to mayors and county judges, a good chunk of that money has been spent by the federal government but has not yet been spent at the local level. It's sitting in bank accounts. Local municipalities in this country are flush with money. That money has to be spent between now and the end of 24. Then there's the Inflation Reduction Act, and particularly the CHIP component is a good example where that's going to stimulate demand for goods and services and workers. Infrastructure bill does the same thing. These are programs you'd normally see implemented after a downturn to help stimulate us out of a downturn. Instead, they're being done pre-downturn. And so that's why I've said, given these cross currents, I think at this point, the Fed can say it's our job and we'll do this alone. But I think it'd be wiser to call for a whole of government approach to fighting inflation. I think you need other parts of the government to do their part here, because the danger if they don't is the Fed's going to keep raising rates. And eventually, I think they already should pause, but it will go too far, cause other damage to the economy to offset it.
Robert, is there still stigma on pausing and then resuming rate hikes? We've seen other central banks do it in this cycle, so why not do that when there's so much uncertainty?
Yeah, I think it's a misconception to think, boy, if we pause now, we'll never be able to get back started. I don't think that's a valid reason to not pause. I think you simply communicate we're in a tightening stance, but we're not taking action in this meeting. And people need to be prepared, and I would say this in the communication, that rates are going to stay higher for longer, and we will move further if we need to in the months ahead.
Well, Rob, what about the argument that kind of the other side of the coin? you maybe are close enough to really putting a lid on inflation. Jim Bullard says 2 more hikes this year. Is that perhaps not the better choice? The economy's already withstood a lot of rate hikes. There's still a lot of fiscal stimulus. So why not use that as an opportunity to get inflation down once and for all?
So I don't think the inflation fight is a 6-month fight. I don't think it's like a fever, and if you raise rates high enough, you break the fever. I think this is a more chronic issue that's going to go on for the next couple of years. Why do I say that? Because of the service sector. The ground zero, in my opinion, of the inflation challenge is with the $50,000 a year worker that can't make ends meet right now. There's 50 million of them. They work heavily in the service sector, and they need to make more money to make ends meet. And there is a wage price spiral going on at that level, at the 50,000 a year worker level. And I think it's going to take a while to settle that down. And it's not 6 months. I think it's more likely the next couple of years. And so if I were at the Fed, I'd be more worried about sustaining the Fed funds rate for longer than I would be sneaking in 1 or 2 more rate increases and potentially breaking something to where we have to retreat. I would rather avoid that.
Robert, we're getting breaking news at the moment. We're hearing that the United States AAA rating could be cut by Fitch. They're now saying that they expect a resolution to the debt limit before the X date, but that there are higher risks that the debt limit won't be raised or suspended. So Fitch now releasing this press statement that they're placing the U.S. AAA rating on rating watch negative, that the brinkmanship among factors in Washington now signal downside risks. So could you react to this? We've seen this sort of play out with an actual cut in the previous 2011 debt crisis already, and we saw the market reaction there. How much more economic risks does this bring?
Well, firstly, I'd say neither side want or should want a default. It's unthinkable, and it shouldn't happen. Having said that, there needs to be a real discussion about more fiscal discipline, because we have a different kind of crisis right now, which is debt is 120% of GDP, present value of unfunded entitlements is 78 trillion. And the deficit in 2024 is approaching 2 trillion. Pre-recession, we need to control fiscal spending. And so I think what's going on with Fitch speaks to the fact that default should be off the table, but we do need a real discussion, because we're going to have problems down the road if we don't get fiscal discipline.
Rob, just one quick final question on banks, on regional banks, on where we are in that whole drama. Is it another reason why the Fed should be pausing now? Could the Fed hurt banks with more hikes?
Yeah, it will disproportionately hurt small, mid-sized banks. Small, mid-sized banks are very sensitive to the Fed funds increase, and their clients who borrow at the Fed funds rate, small businesses, are very sensitive. The drama headline making part of this crisis is probably over, but there's still a slow bleed going on beneath the surface, and that most small, mid-sized banks I talk to are trying to shrink their loan portfolios because they've lost some capital. They may have had some asset liability mismatch in their investment account, and so they're trying to accommodate that by shrinking their loan book. So it's harder to get a loan for a small, mid-sized business today than it was 2 months ago.
The prognosis on investment strategy is what? What asset do I want to own at this point?
Well, we're advising people, despite the very high level yields you were just talking about on the short end of the curve, we think it's time to kind of sneak out the curve, increase duration. And I'd also advise people to start adding in risk assets in the debt market. So, we're talking credit spreads here. And that view is based mainly on our belief that most around the world, inflation has peaked, and with it, central banks are at or near the end of their tightening cycles. And I think investors need to be prepared for that, the next sort of chapter in the cycle.
So, everybody's assuming that there's going to be a debt deal ceiling agreement here, Matt. But It doesn't stop people from getting really nervous. And, Fitch is the first one really out of the gate, out of the ratings agency. Do you expect more to follow? And if so, what's the likely impact?
There could. I think it's, the rating agencies have been given a lot of, people have been talking about it. Why aren't they reacting? So I think they feel under pressure to put statements out like Fitch has done. Of course, we have to wait and see. The base case is clearly, I think politically, nobody wants this to happen. So the base case is that a resolution will take place. I noticed that before that, when this happened a long time ago and S&P acted, it happened after the agreement. So there could be some longer term damage to the rating quality that's assigned to treasuries. Whether that makes a long term difference or not, I don't think so, at least at these minor changes. The question in my mind, though, is that let's say it does happen, then what are the consequences? And I think the biggest risk in my mind is the basic functioning of the financial markets. And that's the risk that we face. Where's the liquidity? How is the sort of the treasury market and the plumbing of the financial system going to be able to handle that type of situation? And I don't think anybody really knows for sure how it will all work out.
So are you advising investors to prepare for some potential default or even a downgrade on the ratings? I mean, or is this something that can just really kind of done and dusted? We won't be talking about in the next few weeks or so, and then we'll start worrying about the Fed once again.
Yeah. So, and you can see this, the cross currents that we were just talking about in the market. There's sort of this near-term threat, and then part of the market is looking already beyond it when you look at, say, the 2-year and so on. So what we're doing, I'll tell you what we're doing. We're keeping some reserves on the sidelines to take advantage of the possibility of some dislocations in the market. I think a default by the Treasury, if it happens, will be a buying opportunity if there's a sell-off. The question is how you'll do that. I think you need to keep some cash on the sidelines, because the question is, if you want to buy something, what do you sell? And if you don't have liquidity on the other side, how can you buy into the downside? So we're advising to do that, and we think that's the right thing to do. But I think about also what the Fed's reaction will be. The Fed is really loath to have to step into this mess, but the number one consideration that they have is to make sure the financial markets are stable, or there's a degree of stability, the functioning of the credit markets and the financial plumbing. I don't think the policy rate is off the table for now. That's not going to be their primary lever. I think when it comes to preserving the financial stability of the system, that's going to mean expanding balance sheets again. So if there's some knee-jerk reaction in that vein, I think the Fed will have to come in strongly to make sure that we can function and transact in the market, and there's not a major dislocation that can then tip into the real economy.
Matt, the message I'm getting from you so far seems to be ready for a turn here, whether that's be liquid or start moving up in terms of duration here. Can you talk a little bit more about that? How much duration do I want? What have you guys been doing? And how far up the risk curve do I go?
It's been remarkable how the market has flipped from worrying about a downturn to worrying about sticky inflation. We have a longer term view about inflation being sticky. There are structural changes in the market that we think are going to keep tailwinds to inflation from a longer term perspective. But in this cycle, we think inflation has peaked. And there's been a lot of talk about why hasn't policy really bitten in terms of the economy. There are signs that it's starting to do that. But remember, the Fed and other central banks were so far behind in inflation that it's taken a while for them to eventually get real interest rates high enough. And that's the key point. So the run rate inflation globally has peaked and coming down while the policy rates have come up. If you look at the U.S. and other markets, you're now seeing the policy rate, and this has been the case for a while now, is solidly positive. And that positive real rate has an effect on tightening market conditions. The banking crisis in the United States was a symptom of that. And with a lag, we'll start to see that bite into the economy. And you were talking about some APAC economies. You can actually see that taking place more forcefully in a country like South Korea. So with that, we would move out the yield curve to take advantage of that.
Matt, are you seeing any liquidity issues out there? I mean, you say that credit isn't rich at the moment. It's sometimes it's a fair price. Is that a function of just generally fundamentals, or is it a function of liquidity?
Liquidity is playing a role. Liquidity in the market is relatively poor across the board, I would say even in treasury markets, and that's been the case for a while. One of the reasons we're advising people to consider jumping into spreads or sort of creeping into the spread markets, the credit spread markets, going down in quality, is that now for the better part of a year now, the market has been forecasting a downturn. And credit spreads had widened. Risk assets have started to price. In other words, assets have priced in some level of downturn. And it's a relatively mild, run-of-the-mill type of recession, or whatever you want to call it, slowdown in global activity. So today, even though we haven't actually flipped to a recession yet, in terms of how somebody would determine what it looks like today, you are already being compensated in the spread markets through wider spreads for that possibility. So we like to get ahead of that, because liquidity on the other side, liquidity goes both ways, right? So it can be harder to transact on the sell side, but also the buy side. And what we've noticed, turn your calendars back to the beginning of this year, when new money came into the markets, in the credit markets, what happened? It was a deluge of money that came in, and spreads tightened because there was no supply to buy. And I think that's what's in store. Right. So let's play this forward a little bit. If central banks start to pause more and more, and even if talk about easing starts to get into the picture from the central banks, there's a wall of money that's going to come into these markets.
I think it's interesting that everyone was shocked to see this sales guide from NVIDIA, which is 50% above the consensus, which is unheard of. Is this just a one-time thing, or something that can actually last?
It can definitely last. What is being communicated, NVIDIA has been down double digits, and it has suddenly now was expected to rebound up to about 30% when it exited the year. Now the company is coming in much higher, much faster. And what it's really communicating is that the company is very resilient and is very insulated. And the reason it's insulated is because the companies with the deepest pockets, all of that cash that they've been saving up, this is your big companies, are buying accelerated computing for the data center, as well as generative AI applications is another big investment. So it's very, very insulated. And you can't say that for most tech companies. Most tech companies right now are coming under pressure from lower CapEx, from tighter tech budgets. But the piece within CapEx that is growing is the market that NVIDIA is serving. This is the beginning of the market really piecing that together, in our opinion.
Beth, to that point, how does one separate winners and losers here within the sort of NVIDIA and NVIDIA sort of peer space? If I had to look at that very narrow investment universe, how are you looking at differentiating those names?
Semiconductors are the piece that is, allowing the accelerated computing. So in the past, CPUs were primarily where data center investments went. But what's happening is they have to move towards accelerated computing, and that's where NVIDIA really sits. Beyond NVIDIA, there are other semiconductor companies that can benefit, and it's really the piece in the stack that is going to grow the most. If you look at projections from McKinsey or any others, we're talking about a $15 trillion market. This is much, much larger than the mobile market. But it's going to be primarily driven not only by semiconductors, but by the enterprise. And that's a massive shift from what we've seen in tech. The last bull market was driven by consumer companies. It was mobile really was the primary trend. So semiconductors is a strong way to participate. And then, of course, companies that have a lot of data because they need to train the models.
Beth, I mean, there are, of course, headwinds, not least the technology war, if you like, with China, the chip war here as well. And Jensen Huang of NVIDIA's already said there's only one China, and it's a huge amount of demand that they would be not getting if it were. And the thing is, then they could end up with, as he put it, the United States swimming in fabs, i.e. the plants where chips are made.
I've held NVIDIA for a long time, and so the China threat is a real threat, and it is what can rock the stock, so to speak. The AI story is very real. This company is absolutely the leader in parallel processing. It will absolutely participate in the majority of the AI market, but then you have this China risk, and I fully understand this China risk because it has brought the stock down very quickly overnight in other, in the past. So there's no doubt that the China risk is real. Taiwan semiconductor obviously is in the middle of that. And so for these major design companies, that includes AMD, China could not be more important.
Yeah. It's interesting. You're quite bullish on NVIDIA, but you're not buying the stock right now, Beth. I want to ask you why, and do you have any sort of price targets that...
I don't want to shock people, but we would love to buy again at the 220 range. Here's the deal is that we have participated from the bottom and we're really happy to do so. But underneath that is a weak macro, and tech gets very affected by any kind of macro news. You've just brought up China. That's a great example. And so the problem is that the company has extended so far, and it's one of the only companies out of three really that is holding up the S&P 500 right now. So we prefer broader leadership basically when we're going to buy.
I wonder if we should talk about the debt ceiling.
I think you're right. There's something happening.
Yeah. What's the assumption you're making there?
Look, the assumption is it does get passed, the debt ceiling does get lifted, because as you just heard Kathleen say, the choices that we would have to make otherwise are absolutely unpalatable. You either prioritize payments on the government debt or payments to the retirees or payments for defense and a variety of other measures. These are not choices that we want to make. So, it would be unthinkable to have to make those choices. So I assume it does get done. But I think what we're seeing right now is very much like in 2011. And by the way, David, I was mentioning before that since 2011, we had so many more of these run-ins where we had to raise the debt ceiling. But the reason why that was not getting much traction and noise in terms of headlines, because there's uniformity. There's Democrats in Congress and there's Democrats in the White House. That's not the case this time around. And so I worry from the investment perspective that this path, the next 7 or 8 days, may be a rocky one trying to get this done.
So beyond just T-bills, as Dave mentioned, are you seeing any signs of stress in the markets over this?
Yeah, for sure. So first of all, if you look at the credit default swaps and you look at the 1 month CDS, it's blown out to actually levels that are wider than we saw in 2011. So this is why this is an acute risk that markets are paying attention to. The other place that I'm seeing that is in the volatility service. If you look at the front end volatility of the S&P term structure, you're seeing that volatility has picked up. We're also seeing if you look at the put options volatility versus the call options volatility, the put options vol is now more expensive relative to call options volatility. So that tells you that, last week we had this market chase and people were buying call options. This week it's once again to buying put protection against, what seems like no deal yet.
And just putting all that together, it seems that once, and hopefully we get past the hump, what are we trading on? Because it's almost like you look at where the equity market is. Yeah. It's almost like this other bit's not happening. The S&P at these levels, NASDAQ at these levels, and I'm wondering if you should still chase this equity market rally looking into 2024 as well.
Yeah, well, I think right now we're in this holding pattern because nobody in their right mind wants to step in and say, let's buy this before the debt ceiling issue is resolved. But if you look beyond that, I do think, David, there's two factors that can support the market. And the first one is the U.S. economy is not falling apart. It might be cooling, sort of, but it's not cratering. And so if you look at the second quarter GDP, we're tracking close to 3%. So that should support earnings growth. That should support upwards earnings revisions, and therefore could support the markets. The other thing I look at is the Fed funds rate. And if we are, in fact, looking at a pause, if not the end of the tightening cycle, then historically that produced positive returns for stocks as well. So if we get past the debt ceiling and we're at these really key technical levels, then I think, you're going to have some chase back into this market. You're going to have hedge fund managers that have already been chasing because their net short positions are actually too short. So they're going to be buyers. You have mutual funds that have raised cash, even in the beginning of this year, that are going to be deploying that cash back into the markets. And I think the retail investor will be back as well. So I think we could have some chase.
So you're thinking S&P could hit, 4,200 if we do get some sort of debt ceiling resolution or something?
I think 4,200 on a debt ceiling resolution, that's very reasonable. Yeah. But beyond that, 4,400 would be sort of the next threshold I have in mind, which is not that far, but 5 or 6% from here. But the reason is, if we can have the same multiple as we have today, which is around 18 times, which I think it's fair given the fact that the economy is not in recession. But if you apply that multiple to the earnings stream that's actually rising because the calendar is starting to flip to 2024 earnings. Yeah. And so it's about $244 of S&P earnings estimates for next year. So you put those numbers together, that gets you to about 4,400 on the S&P.
Does 244 EPS on the index make sense to you for next year? That's the other question too.
Yeah, it does, because I know a lot of people worry about, doesn't it need to be reset lower for the environment? But guess what? It has been reset lower. 2023 estimates were already cut down 10% or more, and same goes for 2024. So as high as the number might look, it's actually been de-risked already.
I'm wondering, you've been 4 days here in the region, what questions you're getting from clients and people that you talk to, because I think a lot of guests here in Asia are quite bearish when it comes to the U.S. When I have bull markets in Taiwan, for example, Korea is close to it, Japan, everyone's talking and loving so much these days. Is the U.S. a bit of a hard sell these days?
It is a hard sell because people don't know which way this is going to break. And, from doing some client events in the region, the takeaway is that 50% of the audience is bearish and 50% of the audience is bullish. And that sort of helps explain why we've not been able to make much progress on the S&P 500. But I think one of the takeaways is that people are willing to start looking at the markets. I feel like at the end of 2022, nobody wanted to do anything with the equity markets. But now, as you look around and the economy is actually hanging in there, and stocks, especially tech stocks, on a tear, people are willing to look and engage in conversations and think about trade ideas. And I will say, Yvonne, as challenging as the environment is, for clients, it's great that you can get paid to wait out the volatility. And I'm not just talking about cash. I'm talking about things like high yield bonds, investment grade corporates, and also private credit on the credit side. So you can get paid. You can get a very decent yield in your portfolio. Yeah. And then slowly but surely step into tech opportunities.
What about cyclicals? Because people have been quite bearish about that. You're looking for entry points now.
I'm looking for entry points into tech, and that's the idea that I continue to like. But from a cyclicals perspective, a contrarian in me wants to look at opportunities in cyclicals because everybody else has fled the space. Fund flows are going into tech; they're coming out of cyclicals. But the cyclicals that I would want to probably invest in would be semiconductors. Because if you have a pickup in, let's say, PC shipments and 5G phone shipments, and if you get clearly you have this massive mega trend in data centers and infusing that with artificial intelligence, if I can get that combination of the uptick in cyclical momentum with this semiconductors being the enabled technology and having secular strength, that's the cyclical I would own.